So, Andrea, I'm sure everybody out there watching this particular video right now may be wondering why I am wearing such a big red tie for this video. Right? I'm sure that's what you were thinking. Well, this video is going to be about presidential elections and your money. You see, because when it comes to your money, politics and the financial markets are often very much intertwined in the minds of most investors when it comes to elections, because they are thinking that whomever is elected to the office is going to affect their financial well-being in some form or fashion. So whether you're a Democrat, a Republican, or an independent, this video was made particularly for you, because we are going to highlight just how significant it may or may not be when it comes to your money and presidential elections. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason that we created these educational videos is to make the difficult and stressful process of retirement income planning simple.
Absolutely, Andrea. And we do this by incorporating a team of highly trained advisors ranging from certified financial analysts, certified financial planners, estate attorneys, insurance brokers, and other needed professionals to help us build a financial written plan for our clients to let them know when, where, and how to pull money from their retirement savings.
For the best retirement income planning advice, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrea, the U.S. stock market has been analyzed, it's been researched and studied for more than 100 years by some of the top minds in the financial industry. They are always looking to try to figure out better ways to forecast what is going to happen in the stock market based off of certain factors. And nothing is more analyzed or has been analyzed than presidential elections. So in this video today, we're going to talk about the correlation between presidential elections and your money. But before we do that, there are always two rules that we want to give you about your money. And what are those two rules, Andrea?
Well, rule number one is to never run out of money. And rule number two is to never forget rule number one.
So let's talk about presidential elections and your money. So every 4 years, when there's a new presidential election cycle, I will have clients who will become very anxious about their retirement situation or their money due to the fact there may be a new administration that's coming into play. And so I created this video to really ease that anxiety that many of my clients get, and I'm sure you who are watching this may get as well. So let's talk about presidential election cycles and the U.S. stock market, because there is a very unique relationship between the two. So when it comes to presidential elections, first, it is important for us to just start with the basics. Of course, the presidential election cycle runs every 4 years, with the congressional election cycle set to run on a 2-year basis, which is, of course, commonly known as the midterm elections. So let's get that part out the way. So when we're taking a look at the U.S. stock market and presidential cycles, historically, there has been a distinct trend in the stock market returns when considering different years of presidential terms. So if we look at this chart, we're seeing a cumulative stock market returns by president for their first 37 months and the percent that the S&P 500 has done at that particular period of time. As you can see, George Bush Jr., he had the worst performance. It was down negative 16% during his first 37 months. And we can see here, if we go to more current, we're only looking at the Trump years up to January 31st of 2020. And we know that the market was taking off and doing well up until the bottom fell out due to the coronavirus. But you can see he was at lockstep with Clinton's first 37 months of the stock market at 42%. And you can see George Bush Sr. was at 45%. And the highest performing 37 months was President Obama at 64%. Pretty astounding there. But you can see these trends are very unique. So let's talk a little bit more about how this actually works.
So, Carson, it's interesting that you say that because I've often heard that whomever you vote for, whether it be Republican or Democratic, that it can affect your retirement savings in a negative or positive way. Is that not the case?
Well, Andrea, it's funny. I mean, a lot of people have that notion that you have, that it's always going to be, if I vote for a certain party, my money is going to do better for me. But as you're going to continue to see from the information that we share with you, that's really not the case. And so we're going to go back to the slides right now and dive in a little bit deeper to show you exactly what I mean by that.
Okay.
So there have been numerous analysis around the unique trend between a presidential election and the U.S. stock market. What we have determined or noticed is that years 1 and 2 of the incumbent president's term historically has given us lower than average S&P 500 index returns, but years 3 and 4 have produced outside returns that have been above average, and so that's really unique. The S&P 500 index for each of the 23 election years since 1928, you can see that only 4 of those years did it return a negative outcome. We don't know what 2020 holds, but we don't know due to the coronavirus if this is going to be a 5th year. So if we take a look at these years in 1932, in 1940, in 2000, and 2008, we can see in 1932, the returns in that presidential election cycle was minus 8.2%. In 1940, it was minus 9.8%. In 2000, of course, we may recall that was the tech burst. It was a minus 9.1%. And of course, the outstanding loss in 2008 was minus 37%. 2020, as I mentioned, is still in question. So who won during that period of time? In 1932, that was Roosevelt. Again, in 1940, it was Roosevelt as well. And of course, 2000 was under the Bush administration. And then when Obama came in, the bottom had completely fell out and we were down 37%. So let's take a look at this very last chart here. It's going to be telling. So in the first 2 years, we can see this dark blue line. The dark blue bar is going to represent the first 2 years, and the light bar is going to represent all 4 years. So since all elections since 1789, this is when George Washington was president, we can see that in the first 2 years, the market has averaged about almost 8%. And in all 4 years since that period of time, the market has done about 9.1%. As we move on, we can see when there was a Republican president, in the first 2 years, the market was up about 8.3%. But in all 4 years, when there was a Republican president, the market has averaged about 8.6%. And when there was a Democratic president, in the first 2 years, the market was up about 5.8%. But then in all 4 years, the market was up about 8.8%. So the trend you can see is that no matter who was president, in all 4 years, everything seems to come out about at even. And so what we are noticing is that the market seems to respond favorably to a Republican president in the first 2 years, but then they warm up to the Democratic president in the last 2 years. So it starts to warm up on an even scale. When there's a Republican sweep, where there's Republicans controlling the House and the Senate, you can see the market responds favorably at 12.2% in the first 2 years. But in all 4 years, we can see clearly that the market comes back down to the means of 8.6%. When we look at a Democratic sweep, first 2 years, as before, the market responds unfavorably at 3.4%. But after 4 years, you can see that the market has now evened out. 8.2% is what the returns have been. When there is a Republican divided Congress, we can see, and this is where you have a Republican president and a divided Congress, we can see that the market was up only 1.1%, but after 4 years, 8.7%. And when we look at a Democratic divided Congress, we can see that the market really performed favorably in this particular situation. The first 2 years at 14.5%. And then in all 4 years, the market has averaged about 11% during that time period. So, yeah, really the anxiety around any president really is unfounded when you look at this chart. You can do well no matter who's in office. The main thing is making sure that your money is just put to work to you at all times, no matter what is going on. You have to separate your political ideology from your actual retirement ideology. So I hope that this information was beneficial to you in helping you understand the correlation between your money and presidential elections. Now, if you have any questions or comments about this video, please leave them in the comment section below. And of course, don't forget to subscribe to our channel.
To learn more about our services and how we can help you to increase your chances of not outliving your retirement savings, please make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. And remember, if you have questions,
we have answers. So I hope that this information was really enlightening in helping you understand exactly how you can actually prepare for your retirement situation. Please leave any comments or questions in the section below, and don't forget to subscribe to our page.